Good morning, Jags. This is Fahad. Today is Wednesday, November 25th. Let's get started. A quick update on a position that I got a text message about from a client who has been holding this position. The stock is called ANGO Dynamics, symbol ANGO. Now, just a quick reminder that if you go to the JAG website and if you go back and look at our webinar summary from October 15th, this is when I presented the bull case for this company, ANGO Dynamics. 3 times Jay has covered with bullish views this stock. The first one was presented in the weekend research on June 21st. So here you go. If you open that, you'll see right here on June 21st, the bull case was presented. The second time was after the company reported a blockbuster quarter on July 17th. We covered that. If you click on this link here, you'll see that. And then the third time, it was on September 30th when there was a specific quote from the CEO that caught our attention. So it was covered at that time. So here we go. If you go to the first read from that day, you will see all the way down. This is ANGO Dynamics in the notable callouts. So then after those 3 discussions, I followed through on October 15th for the 4th time. And I discussed this stock with a bull case when it was finally starting to break out with a new leg higher from this downtrending resistance. So there have been multiple endorsements of this bull case on ANGO Dynamics. Now I bring this up because this morning this stock is going to spike sharply because Raymond James, the analyst Raymond James, is upgrading the stock from buy to strong buy. And this stock has been running strong up to this critical resistance around $13 per share on rising volume in the last couple of days. And just before the market closed yesterday, it started to break out. And looking at pre-market action, I am seeing print on this one. I mean, the volume is very, very light, so we don't quite know, but I'm seeing print on this one as high as $16 with the stock closing at 13. So we'll see 14, 15, 16, somewhere there. This thing is going to gap higher sharply. It's going to be up about 10% or more. And that means this $15.20 target that I had highlighted back then on the webinar in October is now actually quite visible. So if you're holding the position in this one based on all that discussion, I think it's time to cash out and take profit. One quickly, I will mention though, that the bull case, the primary reason for liking this stock has always been, and why we covered this multiple times, it has always been strong launch of Auryon, AURYON. And if you look at today's Raymond James upgrade to strong buy, they say the same thing, which is analysts sees ANGO Dynamics offers the most compelling risk reward in the small cap medical technology coverage. The company's business is still overly diversified, but the growth drivers are more identifiable and the base business has largely stabilized. Bedford is telling investors in a research note that the market that this makes ANGO Dynamics more investable today than it has been in many, many years. And as a result, they believe that the company's budding growth has disguised the stock as a value name. So interesting update. Strong buy is going to spike higher, but I think on this rally, because the RSI MACD will be completely overbought, nice to take those profits and step aside if anybody has a position. So that is quick update on ANGO Dynamics. Now the second stock I want to cover is GOGO, GOGO. Keep an eye on this name. A couple of reasons for this. Number one, the technical setup. If you draw this trend's resistance, you will see that there is a very clear hard wall of resistance right at $11 per share. Multiple times the stock has made attempts to break out through that, but unable to do so. Each time it fails and then it rolls over. And there was a bull flag formation near this level for the last 2 weeks or so. And yesterday it ripped higher sharply and it started to break out. Late yesterday, I started to notice that there was some aggressive call buying in GOGO, both in the month of December and January, especially if you look at the January 10 call open interest, which is 24,000, and you zoom into this and you draw the chart with volumes of this January 10 calls. Let me remove this theoretical price action. You don't need that. So take a look at this closely. This is the actual chart of the January 10 calls, and you can look at the volume in the last 3 to 4 days. So this blue line is the open interest. You can see it has been very steadily rising and rising, but just in the last 4 to 5 days, beginning from November 19, it really started to rip higher because the volume has been coming in every single day. And yesterday and day before yesterday was the most aggressive call volume. Similarly, if you look at the January 11 call open interest, which is 6,900 open interest, and zoom into that, you will see a similar kind of trend that's building over there as well. And so look at this volume. This blue line is the open interest. They showed up with more than 2,000 contracts bought on November 18. Then they took a break, and then they showed up again yesterday with more than 4,000 contracts bought. So now the open interest has climbed to more than 6,000. And similar kind of action is building in December month as well. The point is that has been steady accumulation, and the stock is looking to gap higher by about 2% in pre-market. So the question is, why are they buying calls all of a sudden in the last 2 days? And I think the simple answer to this is the news that came out from GOGO on at the beginning of this week. Believe it or not, this company, which we are familiar as provider of internet services, particularly connectivity to the internet inside the airplane. So when you travel, and you connect to the internet, your mobile devices or your tablets or whatnot, you are likely using GOGO to connect that. And so, how is this a stock able to perform strongly? In such an environment? Well, first of all, travel has gradually come back, and we're going into heavy holiday season where a lot of travel is going to take place. In fact, more than 1 million people traveled 2 days ago, according to the TSA checkpoint through. This is still down on a year-over-year basis. Nevertheless, the travel gradually continues to recover as people wear masks, comply with the ordinances around wherever they're living, and then move on with their lives. So that's the first thing. And the second most important thing is that travel business, the commercial aviation business, in the last earnings report, company actually completely discontinued that business from its earnings report. So they're not even accounting for any kind of revenues. They've zeroed that out into their income statement. The reason is the company is now expecting to actually sell its entire commercial aviation business. And there was a 8K filing that came out with the SEC on November 18th, which is right over here, in which they talked about that based on significant progress in obtaining required government and regulatory approvals related to the previously announced sale of GOGO's commercial aviation business to Intelsat Jackson Holding, including receiving all necessary approvals from FCC and such. They believe GOGO now expects to close the CA sale in early December. And so this sale will be closing sometime in the next 2 weeks or so. Now, so in order to evaluate this stock, now we do not know exactly what kind of money they will get for selling this business, but understand this company is sitting on very heavy amount of debt, more than $1 billion in debt. And so the first thing that is quickly coming in everyone's mind is that once you sell this business, you're going to raise the cash, you're going to pay down the debt. The debt that they have of more than $1 billion pays 9.75% interest right now. And the idea is they'll be able to get a higher rating from the credit agencies, resulting in a lower interest rate. This debt expires in 2024, and the entire tranche, which can be rolled into a new package, and this could be done potentially by May of 2021. And if that happens, just on that piece alone, there could be as much as $50 to $60 million in interest rate, interest expense savings that could be coming for the company. So then the second question is, okay, if you sell your commercial aviation business, what's left in the business? Okay, how are you making money? That comes down to the business jets or business aviation business. So in order to evaluate this, let's take a look at this earnings report that came out on November 6th to see how that business performed. According to the SEC filing, the business aviation trends continue to improve. Revenue for the quarter was slightly better than expected, driven by higher ATG, average revenue per per passenger. Management noted that 75% of the 1,100 account suspensions have returned back, with over 90% at their original or higher priced plans. Additionally, 71% of the 928 downgrades during the key pandemic times of March and April month have now upgraded, with almost 90% returning to their original or higher priced plans. Overall, equipment revenue was in line with the estimate, but ATG shipments came in meaningfully better, with 167 in the quarter, which was a 67% jump quarter over quarter, but still down 34% year over year. Satellite shipments were up. Satellite shipments of 28 was also sequentially improving sharply. The point here is that the business aviation jet business is doing quite well, while the aviation business, which has been struggling, is now being discontinued, which will result in lower interest expense once they pay down the debt as well. So the balance sheet structure will also gradually improve. So there you go. The catalyst is in the next 2 weeks. Once the sale completes, chart sets up for a breakout, and the bulls are loading up call options in January 10 and January 11 strike calls. And that's it from me. Jay?
Morning, everyone. So first off, just want to essentially preview weekend research that'll come out this upcoming Sunday. I plan to take a look at a company called Outset Medical. Ticker is OM. This is a medtech company that debuted on September 15th. They offer a disruptive dialysis technology called Tableau. So I will give you of course, a more in-depth analysis this weekend. Also, possibly planning to take a look at the beauty segment. After the announcement that Target and Ulta, their partnership announcement, a handful of other notes started to come out, really targeting Estee Lauder. I know Stifel believes that the read-through from the Ulta Target announcement would be positive for Estee Lauder. Separately, Morgan Stanley was out with a survey note, detailing Estee Lauder, and then another company, e.l.f. Beauty, which we did cover recently in conversations. Oppenheimer met with management of that company. So I plan to talk about the category in general. Now, the stocks that I wanted to talk about today focus on virtual concepts within the restaurant industry, specifically looking at Bloomin' Brands, ticker BLMN. They launched a virtual brand recently called Tender Shack, which sells chicken tender sandwiches. They originally launched in Tampa Bay and have now expanded to Texas, Oklahoma, Kansas, and Missouri. BMO Capital upgraded this stock on November 15th, and I think the key there is that they have not included this virtual brand in their estimates yet. Now turning to Brinker International, ticker EAT, they also see a lot of upside for virtual brands. Back in August, they rolled out the brand called It's Just Wings to more than 1,000 of its restaurants, and they partnered with DoorDash. On the last earnings call, they talked about how they're well on track to meet their first year target of more than $150 million in sales just from this brand. And in a post-earnings note, Stifel talked about how the brand is already proving popular with customers. Over a 90-day period, more than 45% of its guests made a repeat order. Distribution has also expanded at both its domestic and international franchisee locations. And those franchisees have received positive feedback. And this has resulted in the company wanting to expand the virtual concept idea. They actually have started to test another delivery-only concept called It's Just Sliders and Pies, which began on September 15th in select locations in Texas, California, and New York. So, like I said, virtual brands seem to be popping up more and more within these restaurants. So something to keep an eye on going forward.
Very interesting. So educate me on this one, but isn't this essentially the Tender Shack being launched by both Brinker International as well as the Blooming brand? Isn't exactly what we have been talking about for the last 8, 9 months, that ultimately what this pandemic will do is it will accelerate the adoption of commercial kitchens essentially around the country, where shops will open up with only kitchen, providing full menu of services, no dining rooms, no servers, no nothing, none of that, and will 100% rely on Uber and DoorDash and Grubhub to deliver food.
Yeah, and
And
Chipotle did the same thing recently with their, quote unquote ghost kitchen.
yeah, exactly. Ghost kitchen, commercial kitchen. I mean, I think this concept actually, believe it or not, and was already in the making. I heard about this first time about 18 months ago, well before pandemic, when I was visiting California at a conference, and I met a whole bunch of people. And it just seems like that the COVID accelerated that adoption. So this is interesting, and it's going to be fun to watch how this industry evaluates or reinvents itself, given what's going on with the pandemic. And if we start to see, I think, if I'm not mistaken, and this would be another one to look at, there's also a website, and now it's slipping from my mind. Maybe you can dig it out, but there's a website where chefs, individuals, people that don't work for any kind of company per se, but it's a website designed for chefs working from home, moms and pops or whoever,
Mhm.
creating their own food and variety of menus and selling directly from their home. Because if the concept is that, in a service economy where restaurants are not operating as they used to, then technically speaking, anybody with a decent amount of kitchen and good knowledge of how to make really good, tasty food can actually run this kind of business right from their home. And
Mhm.
so, websites can spring up, basically, we're for chefs working from home and selling, through DoorDash services to anybody. So I think there's a website already out there. I ran into this once before, but it might be worth exploring to see if there's something there.
Okay,
Anyways,
will do.
interesting concept. Purely technically speaking, this is a large, uh, in BLMN. This is a large wedge formation, and if it starts to clear through $18 resistance, then I think this can go all the way to $21 to $22 per share. You were going to say something, Jay?
Oh no, I was just gonna say I will look into the chef
Yeah.
concept.
Yeah, I think I discussed this with clients at 1.2 last year. I may have to dig through my notes, but all right, great stuff. Chronicle.
Good morning. I have a quick update on Jacobs' earnings yesterday. This is
Yeah.
an idea in the latest quarterly outlook, and it's been a nice winner for us so far. So to give a quick rundown of the numbers, the company reported fiscal Q4 EPS of $1.63 versus consensus $1.32, and revenue of $3.52 billion versus consensus $3.42. Separately, backlogs were $23.82 billion versus $23.62 billion expected, with book-to-bill for the year at 1.1. So a solid beat. And then this image that I shared summarizes the operating profit from for their segments, which grew nicely despite the pandemic. Now, there was a bit of initial selling in the stock following the earnings. I think part of that could be attributed to the earnings guidance for fiscal year 2021, which came in between $5.20 to $6, so 560 at midpoint versus consensus $5.81. So optically speaking, the guidance missed. But if we fast forward to the conference call, management clarified that this guidance does not factor in share buybacks plus benefits from their acquisitions, both of which they plan to do in 2021. And so this guidance that they provided has stripped out those benefits, which is why on the surface it looked like a miss. So that's the first thing. The other thing is the outlook and the company's plans going forward. First off, Jacobs disclosed that they acquired a company called Buffalo Group for roughly 9 times annualized EBITDA. Not cheap, but not overly expensive either. But what I'm liking about this acquisition is that it fits right into Jacob's multi-year transition plan towards becoming a higher margin business. We already went into detail about this transition plan in the quarterly outlook, starting exactly from page 100. So regarding this Buffalo acquisition, management highlighted that Buffalo has a multi-year high margin backlog, and with the bulk of it to be realized in the next couple of years. And this is going to be accretive to the company's margins for their critical mission solutions segment, which accounts for roughly 1/3 of the company's earnings. So they're continuing to transition nicely into becoming, by 2023, a more government intelligence and security oriented contractor, as opposed to low margin civil engineering, which used to be their bread and butter. So it's good that they're moving towards security, intelligence, and computing, which is where the actual wars are being fought these days. And I think over the long term, this is going to move the market towards valuing the company as more of a data and technology solutions provider rather than a traditional construction contractor.
Yeah, interesting update. And I do think the quarter has quite a bit of positives. I was just reading it myself this morning. Let's see how the stock reacts today. It has been a great beneficiary of the Buy America, Build America theme and the entire rotation from growth to value that we have been talking about. This is, for those who do not know, this is a top recommendation from the Jaguar fourth quarter outlook. And this is the specific trade idea that was recommended to buy January 95 calls for $7.50 or less. And if you look now with the stock trading at 107, those Jacobs Engineering call options at the 95 strike are now going for about right here for about $14 per contract. So they have almost doubled, and the stock has been gradually marching higher, making another new 52-week high yesterday. Let's see how the stock reacts today, but the quarter has actually quite a bit of positives to take away, and we'll be watching, and then we'll proceed from there. All right, folks, we're going to stop over here. Thank you very much, and we'll see you in the chat room shortly.